Picture this. You're a tax professional, maybe a business owner, and you're currently dealing with a pending tax recovery action. Let's say it's an attachment order on a property, and it was issued under the old Income Tax Act of 1961. Now fast forward to April 1st, 2026. The brand new Income Tax Act 2025 takes full effect. So what happens? Does that old recovery order just magically vanish? Or are you going to have to start that entire grueling process completely from scratch under the new framework? Well, it's a massive, everyday scenario for practitioners trying to navigate this massive legislative shift. Today, we're going to unpack exactly what happens to those arrears and how the new recovery machinery actually operates.
Welcome to this explainer. I'm really excited to walk you through the absolutely crucial collection and recovery provisions under Chapter 19 of the new Income Tax Act 2025. We'll be kicking things off with the general framework of Sections 390 and 391. Whether you're a chartered accountant, a CA student, a tax professional, or a business owner, getting a firm grip on this transition is essential for safeguarding your practice and keeping your compliance absolutely pristine.
Here is our agenda for today. We've got 1. Intro to tax recovery. 2. Breakdown of legal provisions. 3. Practical transition examples. 4. Critical compliance points. 5. Common practical issues. And 6. Summary and key takeaways.
All right, let's dive into Section 1, Intro to Tax Recovery. Okay, first things first, there is a massive paradigm shift happening here, and it's all about the concept of the tax year. For over 60 decades under the 1961 Act, we've all been juggling the previous year, the year the income is actually earned, and the assessment year, the year it's taxed. Let's be honest, it caused endless confusion. But under the new Income Tax Act 2025, the year of income and the year of assessment finally share a single, unified reference. So the income you earn in financial year 2026-27 is quite simply assessed for tax year 2026-27. Grasping this right now is absolutely crucial, because every single recovery notice and demand certificate moving forward is going to rely entirely on this new terminology.
Moving right along to Section 2, Breakdown of Legal Provisions.
So under the general provisions of Sections 390 and 391 of the new Act, once an SSC fails to pay a required demand, they are formally deemed an assessee in default. Now, for decades, the moment a taxpayer hit that default status, we instantly pulled up Sections 222 and 223 of the 1961 Act for recovery. While statutory alignment changes the game, we now look straight to Sections 413 and 414. Once the default is firmly established under the general rules of 390 and 391, the Tax Recovery Officer, or TRO, steps in and assumes jurisdiction under 413 and 414 to drop a certificate and kick off the recovery. So the essence of the law, it's still incredibly robust, but the statutory pathways have entirely shifted.
And make no mistake, this new law has some serious teeth. It operates under Rule 225 of the Income Tax Rules 2026. Once the TRO gets involved, they are armed with 4 highly potent mechanisms to recover those tax arrears. First, they can attach and sell movable property. Second, they can attach and sell immovable property. Third, they actually have the extreme power to arrest the defaulter and detain them in a civil prison. And finally, they can appoint a receiver to manage the defaulter's properties entirely. These powers are specifically designed to guarantee the swift collection of revenue, which means absolute vigilance is required from tax professionals when representing clients. But hold on. The law does provide some vital statutory safeguards. The most critical one here is Rule 83 of the Income Tax Rules 2026. This explicitly limits the TRO's power of arrest. A tax recovery officer absolutely cannot order the arrest and civil prison detention of a woman, a minor, or a person of unsound mind. This is a crucial exception you've got to keep in mind, especially when you're advising vulnerable clients who might be facing these severe recovery proceedings.
Let's look at Section 3, Practical Transition Examples.
Now, here's a highly common question I get from practitioners all the time. What exactly happens to tax recovery certificates or attachment orders that were already issued under the 1961 Act way before April 2026? If the 1961 Act is officially repealed, do all those old orders just lose their legal backing? The answer is a definitive no. According to the transition guidance, any rights, benefits, obligations, and liabilities that arose under the old Act, they continue to exist. So if a property was attached under the 1961 Act, that attachment remains fully valid even after the 2025 Act kicks in. For any remaining unpaid tax arrears raised under the old law, the department is just going to seamlessly pivot. They'll use the recovery machinery provided in Sections 413 and 414 of the new 2025 Act to collect them. It's essentially a continuous, unbroken chain of enforcement.
Okay, on to Section 4, Critical Compliance Points.
You can say goodbye to those old manual text-heavy formats. Enter Form 153. This is the new statutory certificate and notice of demand issued by the TRO under the new framework. It totally replaces the legacy forms and is completely redesigned for our digital-first environment. This fundamentally improves system integration across the board between the assessing officer, the central processing center, and the TRO.
So, when you or your client receives a Form 153, you absolutely must execute these mandatory compliance checks. First up, verify the generation of a Document Identification Number, or DIN. Every single Form 153 must have a DIN for digital traceability. Without it, the communication is technically invalid. Second, confirm the strict usage of tax year on the documents. If you see any reliance on the old assessment year terminology on these new forms, it's going to lead to major processing errors. And third, for those tricky transitional years, you've got to reconcile annual tax statements separately to ensure old arrears aren't accidentally duplicated by the new system.
Next up, Section 5, Common Practical Issues.
Look, the biggest trap for accountants and tax professionals is going to be this overlap period. It is incredibly easy to accidentally mix up financial year 2025-26, which remember is governed by the old 1961 Act and still uses the assessment year concept, with tax year 2026-27, which is governed by the new 2025 Act. When you're making tax payments or responding to recovery notices, you have to ensure all chalons and forms correctly reflect the exact statutory regime. Honestly, keep a section mapping reference handy right on your desk so you don't mistakenly quote Section 222 when you're actually trying to respond to a Section 413 demand.
Let's wrap it up with Section 6, Summary and Key Takeaways.
All right, here are your core takeaways to remember. First, update your statutory references right away. Sections 413 and 414 are your new go-to recovery provisions once a taxpayer is deemed in default under Sections 390 and 391. Second, banish the phrase assessment year from your vocabulary. Moving forward, it is all about the tax year. Third, expect to see Form 153 for demands, and always verify that DIN for digital traceability. And finally, you can reassure your clients that the transition is seamless, but definitely remind them that old recovery actions, like those property attachments, remain fully enforceable under the new Act.
I really hope this breakdown helps you navigate Chapter XXI, the new Income Tax Act, with total confidence. As we transition into this new era, the real question you need to ask yourself is, are your internal systems actually ready to seamlessly map the legacy defaults of yesterday to the strict digital enforcement of the 2025 Act? The law is changing, so make sure your practice changes with it. Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.